Hello, all you lovely people out there. How is everyone doing? I'm Kate Hill, and I am here to give you the best, unbiased, honest content on property, along with fantastic hints and tips. So stay tuned for all your latest property news. Interest rates have been lifted a further 50 basis points by the Reserve Bank of Australia in its third monthly rise in a row after inflation showed no signs of a significant slowdown. The cash rate now sits at 1.35%, up from 0.85% as a result of Tuesday's meeting of the RBA board, in a move that had been widely predicted by the nation's economists. We thought a 50-point rise was most likely, with the RBA Governor Philip Lowe wanting to bring inflation back from its current 5.1% into the 2 to 3% band, said the Commonwealth Bank chief economist. Now, that's against a global backdrop of tightening monetary policy, with other countries' central banks like the US, New Zealand, UK, Canada, Switzerland all raising rates, and the rest of Europe to follow. But while the market is saying that the rate will peak at 4%, we believe it will be lower at 2.1%, he said. We can already see higher interest rates having an impact on consumption, with house prices in some markets softening a little bit, but not in others, and CBA credit and debit card spending data indicating that consumer spending is beginning to moderate. We believe that the rate rises are having a bigger impact than the figures so far suggest. We'll see an ongoing slowdown in consumer spending and then a slowdown in inflation over the next few months. At the same time, while wages growth remains low at 2.4%, it is beginning to grow and will be closer to 3.5% by next year, given the labour shortages and bullish economic outlook. That will mean more pain in the short term for families hit by higher costs of mortgages at the same time as rising prices in the supermarket, at the petrol pumps, childcare centres, etc. The RBA governor has made it clear that the bank will do whatever it takes to get inflation down. The challenge is that it does take time for each rate rise to flow into the system, and we haven't seen the full effect yet. The people on variable rate loans will be taking the hit sooner, but with a large proportion of Australians on fixed rate loans, when they expire, the gap between what they're paying now and what they will be paying in the future is growing. Now, keep in mind that we are still at historic low interest rate levels, and we are not at the same level yet that we were at pre-pandemic. The RBA introduced those monetary policies in those extraordinary pandemic environments that we were in to help the country survive the pandemic. There has been a second consecutive month of small value declines in Sydney and Melbourne. Australia's third largest city, Brisbane, has seen growth in housing values flatten out to just 0.1%, while Adelaide remains the only capital still recording a monthly growth rate of 1.3%. Growth in Perth's housing values, which were temporarily showing a second wind as state borders reopened, are losing a little steam, with values up 0.4% in June. The combined regional markets remained in positive growth territory, rising 0.1%. Unit markets are holding their values a little better than houses across the largest capitals at the moment. Sydney recorded a minus 2.1% fall in unit values, and Melbourne a minus 2.4% quarterly, both lower than the housing market decline. The stronger performance across the unit sector comes after house values consistently outperformed units through the upswing. Since the onset of the pandemic in March 2020, capital city unit values have risen 9.8% compared to 24.7% for houses, resulting in better affordability across the medium to high density sector. Now, remember, everyone, that the capital city markets are made up of lots of smaller property markets. Not everywhere is declining, and we are returning to those more normal market conditions where some suburbs and price points are going up Some are going down, some are flatlining, and for different reasons. It is not all doom and gloom out there, despite what the general media out there will have you think. Labor governments throughout Australia need to pay more attention to the needs of those living in high-density housing, according to the Strata Community Association. Now, its senior vice president says that the 2021 census data reveals 10% of Australians live in an apartment. He says that this shows how important it is for strata housing to be at the forefront of policy making. A quick examination of the housing data from that census indicates a tremendous trend towards higher density apartment living. In the 2016 census, there were estimated to be just over 1.2 million occupied apartments across the country. Now that figure has increased to approximately 1.7 million. Now that is about 100,000 apartments being constructed on average every year. They say that there needs to be recognition of this growing shift to shared housing. The days of the quarter-acre block with a yard being the norm are rapidly receding. Reforms are needed to help ensure that we manage this shift correctly. And that demand for unit markets is really only going to be increasing as the demand for that high-density living picks up. Borrowers are shopping around for more competitive interest rates, with the big banks losing out to more minor lenders. Online property exchange PEXA figures show that the number of people refinancing their mortgages is rising. PEXA's data covers 95% of refinancing commitments. It shows that the big four banks are losing thousands more loans than they are winning each month. PEXA head of research says that the number of refinancing deals lodged through its platform has increased almost 50% in Queensland, 46% in WA, 23% in Victoria, 15% in New South Wales. A Macquarie Bank analyst says that the mortgage market increased about 31 billion in the 3 months to April, but the big four banks accounted for only 11 billion of those loans. He says that in the past, the big banks were able to offer those rock-bottom fixed interest rates below what the smaller lenders could, but that is actually no longer the case. And as a result, the big banks are losing market share. Household wealth figures are rising, thanks mostly to growing property prices. According to the released ABS figures, total household wealth rose by 1.2% to a record 14.9 trillion in the March 22 quarter. Residential property assets contributed 1.4 percentage points to that growth. ABS Head of Finance and Wealth says that even though the pace of property price growth has started to moderate in Sydney and Melbourne, increases in other capital cities and regional areas has resulted in an overall rise in house prices during that quarter. The figures show that wealth per capita is now at a record high of over 574,000, which is 0.6% higher than the previous quarter. Although household wealth has increased, the report found that superannuation balances are down 1.3% as a result of the poor performance of overseas share markets. The ABS says that since the start of the pandemic in 2020, appreciating asset prices have boosted household wealth by 35.3%, and residential property accounts for most of this growth. Now, I will keep you posted on all things property as always as our year progresses. And if you are enjoying all the free content, then please don't forget to subscribe to the channel and hit that like button. And I will see you all again really soon. Bye.